Hello, everyone, and welcome to our June 9th, 2010 Forex training. It's a special presentation here. You're going to get some FXDD people on Forex Street, so we're very pleased to be here. And today is a great show. So, a disclaimer, we do not give buy, sell, or hold recommendations, and that trading is risky. You want to make sure that you trade only with risk capital that will not affect your lifestyle in the Forex. Now, the training today is actually in a series. We're doing 4 to start. This is number 3. The series is called Anticipating Forex Trends, and today's episode is called Freeze a Crowd. This is a trading strategy that Greg Michalowski has created and works really, really well, so we'll talk about that and how you can use this strategy as well to spot trends in the market. Presenters today, well, Greg Michalowski, he's the FXDD Vice President. He's also the Chief Currency and Trading Analyst at the company. He is quite a speaker. I think you're going to enjoy hearing from him today. Many of you already know him from his speaking engagements around the world. Also, just to let you know, Greg will be speaking at the Los Angeles Traders Expo. That's this week. He's actually doing 4 different engagements. One of those, I believe, is going to be a big one, main stage. So that is great. If you're in LA, go see Greg speak. Myself, I'm Sean Powell, one of the FXDD national trainers. I'll be here to feed questions to Greg as he's doing his presentation at the right time. So definitely feel free to put questions into the question and answer chat window, and we'll definitely get to those as best we can. So a couple things going on at FXDD right now. Well, we have our pole position bonus contest going on right now. The highest bonus we've had yet is a full 8% on your trading account when you decide to fund your accounts. We'll know on Sunday after our team races again in the Formula One race. They're in Montreal this weekend. That'll let us know what the bonus will be for next week. And then as well, we've got our Formula One contest going on right now. You can get all of the details on how you can win 2 passes, VIP team passes for the next race, and $5,000 for travel and accommodation. All of the details are available at FXDD.com. Lots of cash prizes and different Red Bull merchandise that we're giving away. So this is a really great contest. You want to check that out again, FXDD.com. Okay, so now webinar housekeeping here at FX Street. This training is going to be on Forex market analysis, trading strategies, and about how to find trading opportunities for yourself. Please participate. Ask lots of questions in the chat window. Keep them to the Forex topic, though, please.
I'd like to start off with a question to ponder here, and it's a very simple question, and I assume that most of you have traded Forex, what the question is how many people made money trading in the last month? How many people made money trading in the last month? And I don't know what the responses are for the number of people here in the room here today, but I do know at FXDD how our customers did over the last month trading the markets. And quite frankly, it wasn't all that great. The account values lost money overall and lost, decent amount. So if you're in that camp, let me show you what happened over the last month, and we'll see how and we'll see what the opportunities existed in the market. And if you didn't make money, there may be a little problem with your trading, and that's what we're going to try to fix here today. So if you look at this chart right here, and this is the beginning of May, and you can see this blue line. This blue line represents our 100-bar moving average. It is our trigger. It tells you that either you should be short below it and long above it. If you listen to our previous presentations, you would have learned that the 100-bar moving average is what we look at. We look at that as our trigger, and from this perspective, the market moved below the 100-bar moving average and started a trend to the downside. And in 4 short days, the market moved 678 pips from this point where traders would be interested in selling the market, and where they might be interested in buying the market. And I put this down at 125.78. Why? Because we had this nice channel going down here, and the market failed on the break of the channel. When the market fails on the break of the channel, leaves this big, huge tail to the or tail on the downside. This gives a clue that the market is probably bottom. Up until that part, the market was in a nice little channel, 4 days, 678 pips in 4 days. That doesn't happen too often, does it? But let's see how this progressed as the month went on. And so, well, let me go back here. This was on May 7th, and then on May 7th, the market, this is the end of that. This is that tail. The market corrected, and then we started another trend. And I guess on Monday the 10th, the market started the same type of move to the downside. We broke through the 100-bar moving average, and we stayed below that blue line, stayed below the blue line, formed this nice channel to the downside. Look what down here. We had another failure down here at the bottom. Does that look similar to the previous chart? Sure does. This time it only went 572 points. So combining the two moves, which took 4 days and then another, I don't know, another 4 or so days of trading, we had gone 678 plus 572, all in a nice trend move to the downside. How many of those pips did you get? Those 1,250 pips did you get over that time period? Then we move on and we go to the 18th, and the market had corrected up 100 bar blue line, confirming moving average, and we move below that moving average, and we have the move to the downside. If I didn't draw in a channel line here, but you can see here that the market broke out of the bottom here and did a similar type move, and we started to consolidate here. And in this case, the market went 216 pips, and this is a 5-minute chart. This is less than a day's time period, folks. So in less than a day, it went 216 pips on a nice trend to the downside. How many pips did you get on that trend? So far, we're at May 19th. We started on May 3rd, and we've seen 1,466 pips of just falling below the trend line and getting out when the market moved above the 100-bar moving average here, or another key level that indicated that perhaps the trend was over. Then we move on to the 21st and to the 24th. This again. This is a Friday and this is Monday, and our moving average, we came up, tested the 100-bar moving average, our favorite moving average, and we started to move down. I must admit that we did get back above that blue line here for a total of 10 minutes here and maybe 35 minutes here. I think we had one close or a couple closes above that line during this point right here. So there was some fear, maybe maybe some traders had covered their position here, but if they we're following the rules and we move back below and we start to move this, in this move down, you get short again. In this case, the market went 161 pips again. This is less than a day. This is a 5-minute chart here, folks. So now the combined total equals 1,627 pips. Move to the 24th, we get to another indication where the market moves above the 100-bar and then comes to the 100-bar test. It moves below it and starts another trend to the downside, staying below this 100-bar moving average, 106 up to 1787. We have another day where the market comes up to, we have the correction to the upside, and the market moves below the 100, comes to the 200, gets up, backs up to the 100, and then starts another trend to the downside and ends right here at the bottom here where the market consolidates and moves above the 124 pips. We're up to 1,911 pips. This is 1 month from the day we looked at the May 3rd or May 7th when we started. And then we have another day in June here where the market comes below the 100-bar moving average, tests the 100-bar, and then does another 261 pips to the downside, staying below the blue line again. 5-minute chart, 2,172 pips. And even on the corrections during the month of May into early June, you had trends as well, and it followed the same pattern. What is this? The market goes above the 100-bar moving average, comes up, tests 200 down to the 100, breaks through the 200, and moves 143 pips to the upside. That's another 143 pips that you can add even on a corrective move and just following our rules. So 143 pips. Let's look at this correction. Does this look familiar to this? Come up above the 100, come down, test 200. Let's go back here. Above the 100, test 200, come down to the 100, move up 146 pips to the top side. Another indication, another trend type move to the upside off of our moving averages. And then a third correction. In this correction, the two moving averages, and the market breaks above it, breaks above this high right here and goes 204 pips to a top here, and fails at the top, comes back down to 100, pip to the upside. So a total of 493. And let's add another one, May 19th, where the market, same analysis, two moving averages converge, start moving to the upside, come back below the 100-bar moving average, 186 pips to the top side, 679. So over the course of the last month, the trend down pips totaled 2,172 pips. The counter trend up pips went 679 pips, and the total trend pips were 2,851 pips. That's 28 big figures, folks, in trend type moves that all were off of a trending market. So if you had one lot of contract, you would have made $28,510 just by following the moving averages, following the trends. Now, again, I asked people out there, how many of you made money in May How much money did you make? Did you make anywhere close to this type of money? I would not expect that you got anything close. Maybe if you made 10% of that, maybe 15%. But the fact is, folks, is that if you didn't make money, or if you didn't, if you lost money, then you lost, not only you lose money, but you also lost the opportunity to make money in what was a once in this year type move over the last month, and that was all following trends. So if retail traders lose money when the market is trending, they're also not making money when the market is trending, and that's the killer. That's kind of the double-edged sword there, where you're getting it from both sides, folks. And so you have to look at yourself, and that's why you're here today. And is that you want to learn, and you want to learn, okay, how can I catch these trends? How can I anticipate these trends? That's what I'm going to be trying to do here today. So here's another pop quiz. If you're looking to trade a trend, would you look to trade choice A or choice B? Choice A or choice B? Oh, choice B is a trend moving down. Choice A is moving sideways. I get. That's interesting, because in my book the choice is A. The choice is A, and I guess I guess you could be semi-right, semi-wrong here, but the choice is A, and the reason is the lesson here today. And the lesson here today is by taking a look at our two moving averages here and looking at the market and how they combined here with the price. And what I call that is three's a crowd. That's when the two moving averages and the price converge. And oftentimes that's a way to anticipate that the market is going to move away from it. It's going to trend to the downside. Now, in this case, this is the area that we were looking at in the last chart. And I should have said that, I meant to say, let's just say that, is that if you were going to do B, which way would you be? Would you be long or short? And, I did this in hindsight, and I assumed that people would be looking to get on the trend and continue on the trend to the downside. But in some people's minds, as Paul said, he would have been long. But in reality, because the market was below this 100-bar moving average, remember the 100-bar moving average is our buy or sell point. If you're below, you want to be short. If you're above, you want to be long. We are still below the 100-bar moving average, so it really wouldn't be necessarily a long situation just looking at the moving averages, but you could have said we had higher lows as well. So I'll give you the benefit of that. But really, what I'm more concerned about is when the market is non-trending, when the market's going sideways. And once again, we have the moving averages, and why we use the moving averages in our analysis is because it defines trends, and they also define non-trends, and I'll get that in a second. They also give what I call an unambiguous trading bias, and I touched on that a little bit before, in that if you're above the moving average, it's bullish. If you're below, it's bearish. And so you have it. That helps keeps your fear down. Why does it help keep your fear down? Because you're able to define your risk. You're able to know that, okay, if I sell the market, at this point, I'm going to be where is my risk? The risk is, if I sell the market because it's below a moving average, like we saw in all those series of charts where the market was trending to the downside in the euro. If I sell below the moving average, that's where's my stop? If the price goes above the moving average, give or take a few pips, and sometimes if you catch that trend, you just manage that risk, manage it until it tells you to get out of that trade. So by using an unambiguous trading tool and a thing like a simple moving average, it tells you about trends, it tells you about non-trends, and I'll show that in a second. It also gives you unambiguous trading bias, a bullish or bearish bias. This helps keep fear down, and it helps define your risk. Once again, the moving averages that we use, the 100 bar is always a blue line. And this is a market-watched moving average. People tend to watch that moving average, and judging from the charts that I showed you, that was true. And also the 200-bar moving average is our confirming moving average. I'll move to the 200-bar moving average to see further momentum in the direction of the break. So if I were to verbally say that to you, say what happens. The market goes below the 100-bar moving average. Its next target is a 200-bar moving average. If it gets to the 200-bar moving average, that confirms the trend in that move, and that's what that gives you more confidence in that directional move. Now, what happens when, and we saw this in some of the charts previously, and I pointed it out a little bit, when the two moving averages and the price converge, and that's what I call threes a crowd, and it's kind of like two's company, three's a crowd. It's like when you go on a date or whatever, or it's that old saying that when three are together, one of you has to go away. If you're going on a date with your honey and you have your honey's friend come along or your buddy go along, one of you is going to say, get him out of here, get her out of here, I want to be with you. Three's a crowd, get out. So when the 200-bar and the 100-bar moving average converge with the price, that's called three's a crowd. And that is an indication to me that the market is non-trending, but you can expect that the price will likely start to trend and break away. And why can I say that you can expect that to happen? And the reason is, folks, is that it's what I call a theorem in trading, and that is this: that if the market is trending, what can it next do? So if the market's trending higher or it's trending lower, what are the things that it can do if it has two choices to either trend or non-trend? What are the two things that it can do? It could either, continue to trend, it could reverse the trend, or it could do a third thing, and that is non-trend. So when the market is trending, the next thing that it possibly can do is non-trend. So that's a clue. Now the other thing, the other side of that is if the market is non-trending, what is the next progression that it can do? And if the market is non-trending, the only thing that the market can do next is eventually trend. If the market is non-trending, the only thing it'll eventually do is trend. Now, we don't know if it's going to trend to the upside, or we don't know if it's going to trend to the downside. All we know, it's going to trend. And that's an important thing to understand, because if you know that the market is non-trending, you can anticipate a trend. You just have to get the direction right. You just have to go to those charts that we saw in the previous examples at the beginning of the session and say, all right, which way is this going to go? It's non-trending here. Which way is it going to go? Is it going to go up or down? And how do you know which way it's going to go? By following the price. As retail traders, the only thing we know, folks, is the price. We don't know all the little, we could know some of the fundamentals, like an economic news thing comes out, but we don't know that, as Ed was saying before, that AIG or Prudential is not buying sterling or buying sterling, or not are selling their dollars that they bought earlier and buying sterling. We don't know that's necessarily happening as retail traders. We can say that it is after the fact when sterling goes higher, but we don't know for a fact what is going on out there. That's fundamental news. That's really part of the price, and the price reflects all those combined fundamental news and stories and ideas and also things like the technicals go into what is called the price, and the price is the only thing we know. So we as a trader have to then apply tools to that price in order to try to anticipate which way the market bias is going up or down. And that's why we use things like the moving averages, and that's why we look for things like threes, a crowd, because it tells you that look for the market to move, anticipate the market to trend from its point. So let's take a look at an example here, and we'll take a look at the example here, the euro versus US dollar. And this is a 5-minute chart here, and this goes back to June 4th again. And this is probably one of the charts that we saw earlier in the program, but we're going to spend a little time here. And what we see here is the green line. That's our 200-bar moving average on the green line. We also have the blue line here. That's the 100-bar moving average on our chart. And when these two converge here with the price, obviously, look at this this range here, very narrow. Market tries to move to the upside. Would I have gone long at this point right here, seeing this? Sure. Why not? I would look for that move to the upside. But what else am I looking for? Since I'm anticipating a trend, I am looking for momentum in the direction of the break. I would look for the market to move in that direction. When it doesn't, when it comes back to the 100-bar moving average and moves below the 100 and comes back in this range, do I lose my appetite for anticipating a trend? No, I don't lose my appetite for anticipating the trend because these moving averages are still moving sideways. They're still converging. And this, in fact, increases my appetite for the downside because this failed. This didn't do what it should do. And that's what I call my if-should rule. If the market breaks above the 100 and 200-bar moving average, which are converged, which are threes a crowd, we should see the market continue in the direction of the break to the upside. If it doesn't, get out. Or if it doesn't, look to go the other way, because the same conditions existed here as they did here. Does everyone understand that? All right, good. So if you could see that and anticipate that, and you are on your way to anticipating a trend. Now, when the market breaks the 200-bar moving average and comes up and tests the 100-bar moving average and fails to get above this 100-bar moving average, you are confident that in your trade, you are still anticipating the trend, and you are confident that you're going to see some sort of move away from this area. Why? Because three's a crowd, folks. Three's a crowd. The market doesn't like to stay around two moving averages that are 100 and 200 bars long with the price. It'll look to move away. And so what happens? The market starts to trend to the downside. And by this point right here, if you're not already short in this area right here, you're looking to get short below this area right here. And where is your stop? Where is your stop? Your stop is if the market doesn't do what it should do. In this case, the market didn't do what it should do. You get out right there. In this case, if the market were to turn around and reverse back up to the upside here, what would you do? You'd get out. So you get out if the market moves above the moving average. That's why this is an unambiguous trading tool, because it tells you the bias is to the short side if you stay below. If you move above, it's now bullish. So get out. And that's and the second part is that if-should rule. If the market, two moving averages come together and the price starts to move down, the market should go lower. If it doesn't, get out. So this is where it all happens here. This keeps your fear and risk to a minimum. It also allows you to try to anticipate a trend. And when it happens, some people may say, oh, well, that's lucky, you just got some news or some event or something like that. But successful traders, folks, tend to make their own luck. They make their own luck because they know what their risk is and they're comfortable with their risk. And that risk is limited. And that allows them to be lucky, to make their own luck and have the odds go in their favor that the market is going to trend. So what do we see? We see a step down. We see a consolidation. Could you imagine that this move from here to here, this retracement is less than 38.2% of Fibonacci retracement, which is another tool that I use? Probably so. This looks like it's the 38.2 would come in somewhere around here. We also have the support here. It fails here. It starts to move to the downside, comes back up, and it moves down again, have a consolidation, a final move to the downside, and then the market consolidates and allows the moving average to catch up with the price, and the market moves above the moving average, comes to 200, blah, blah, blah. It does its thing, like we saw in the previous charts, in some of the patterns that we saw. So this is an example of three's a crowd. This happened on June 4th last week, 259 pips to the downside, all set up because you anticipated the trend. You have to anticipate a trend in order to catch a trend. And you have to anticipate a trend in order to catch a trend. It also, if you anticipate a trend, it also in your mind says this. You should, if you're anticipating a trend, you should look for the trend and you should stay on the trend as long as you can. Why? Because you're anticipating a trend. If you don't anticipate a trend, you're coming down to this level right here and you're getting out and you're saying, oh, I made from 80 to 90. I made 90 pips. Not bad, but look what you missed. You missed this whole thing because you're anticipating a trend to the downside, and you let it happen. You let it happen. Okay. So that's example number one. Example number two is this, and then I'll get to your question. So I see them, and we'll get to them in a second. Example two is the Aussie versus US dollar. This is an hourly chart. This goes back to May, so this works on not only things like 5-minute charts. I look at hourly, I look at daily charts as well. But you look for this opportunity in hourly chart, and you tend to get even a bigger reaction, or there is an opportunity for a bigger reaction. And the Aussie was going sideways, and the two moving averages were converged, and we had breaks, false breaks to the downside, and false breaks to the upside, and all. And then we get really, really quiet here. I mean, really quiet here, where the market's non-trending. What do non-trending markets do? Transition into trending markets. And we start to break to the downside, taking out lows, continuing down, and finally this large tail at the bottom where the market breaks through to the downside and leaves this huge tail to the downside. Gives the clue that the market is done. We come up to 38.2%, come down, back down to that same tail area, and then start to move up. The profit potential is into this area right here for this trend, all because you anticipated a trend to the downside. You let it happen. You let it happen. The third example, this is dollar Canada. This is the 5-minute chart in the dollar Canada. The two moving averages come together. The trend narrows. You'd be looking for the market to show momentum to the downside on the break here. Does it show the momentum? No. It comes back up, comes back down, comes back up, goes up, gives a second chance right here to stay in the trend. Where's your stop on this trade? Still below these, somewhere down in this area right here, 10 or so pips below the moving average. So even if the market goes up here and comes down here, you're still in the trade. The market goes up, it trends to the upside, gets out right there, 241 possible pips. This is this morning, the euro versus the US dollar. This is the 5-minute chart. The two moving averages are converged. Look for a move to the top side, fail, come back down, come around here, get another opportunity here, and this time the market takes off to the upside. The three's a crowd scenario, folks, or the three's a crowd clues that the market gives you are ways that you can anticipate a trend. And once again, if you anticipate a trend, you're more likely to catch a trend. And if you anticipate a trend, you're also more likely to stay on a trend. You don't want to be like don't want to have another May go by, another May and early June go by, where the market moves that much on trend type moves without you catching those trends, folks. So as a retail trader out there, you have to look for these trends. You have to follow the tools that we outline, and it could be as easy as moving averages. I use other tools as well. This is just a sliver of what I look at, or not. It's more than a sliver. I look at trend lines, I look at Fibonaccis, and I look at moving averages. Those are the three tools I use. Ed was talking about using 6. I don't use RSI. I don't use those things. Those are what I call ambiguous trading tools. What I'll use is unambiguous trading tools, and I'll combine them together to try to look for those trends, to anticipate those trends. And the Threes Company is one of those that I look at. So I have about 10 minutes left now. So why don't I take some questions from you all, and we'll see, and I'll be happy to answer those questions. Sean, why don't you outline them for me, okay?
First question we're going to talk about, it's a trading question, and a few people here have been asking sort of the same question. We use a daily, a 1-hour, and a 5-minute chart. Where do you do your analysis, and then where do you look to enter a trade?
All right, boy, that wasted some time. But what we have here in the hourly chart, I look at the hourly and the 5-minute chart, and what we have here is the what I could see in this chart, first of all, from a visual, is obviously the market is consolidating. It trended here and it consolidated here. I also have lines coming in here at lows, and you can see we had a low here, we had a low here. We had a series of lows at this level right here. We had a series of highs. It's 1968 was a key level for me, and we had some highs. We had some lows here and highs here, and then we had the initial high at 1991. I left it at 1991 here. This is the week's high on Monday. Even though the market went up and broke that yesterday, why did I leave it here at 1991? Because this failed up here. The market went up there and failed quickly, and that's what caused it to go back down to our support. And you can see how support held, and when we broke the 91 level, we used it. I'm going to zoom in here. We used that 91 level as our support level to the upside. So, but as far as the threes company trade here, it was all kind of set up here at this point right here, and this point came in at 1951. The two moving averages converge with the price. I'm anticipating a trend, and you start to see the momentum to the upside. And note here that we go above this 81 and we run into the 91. We come down, give another test of this. But also note what these moving averages are doing at this point. This is another point, is that they're starting to move up here. We're starting to get them both to move up. In this case, one's moving up, one's moving down. They're kind of oscillating around here. But here we're getting to see the signal that, okay, it's time to move, folks. And this gives another buying opportunity, a second chance for traders to actually get in. Where's your stop? Below these two moving averages. What's your risk? From here to here. How many people, or a little bit below that moving average, maybe down to here. How many people risk that, or lose that amount of money, or will risk 50 pips on a trade? This isn't 50 pips, folks. This is much less than that. But this is what you're looking for. And why are you looking for this trade? Because you anticipated a trend, and then you get the move. You get the move to the 91. It starts to break higher. We get the move through the 17 level, which by the way is this 100. Around this 100-hour moving average. The market moves above it, comes back down, moves above it. So right now, everything was kind of off of this 5-minute chart, but it also anticipated by looking at the hourly chart as well. And then once we get on the trade, we start to look for the targets that we have to get through. We have to get through the 91 level. We have to get through the 100-bar moving average. And look at this next target that we have to get through. This 38.2% retracement, this move down from year to year. The market stopped at that 38.2% retracement. It's finding some resistance at that level. So right now, if I were to analyze the market from a standing start here, I'd have to say you got to be, if it breaks 120.48, we should head up toward the 78 level and then the 50% retracement. And we should find buyers against the 100-hour moving average below. If the market breaks below the 100-bar moving average, we should see further liquidation with a test perhaps to the 91 level. And if we break the 91 level, we can come all the way down. This would be a fail off the 100-hour moving average, and I would be more bearish if the price moved back below that 100-hour moving average. So it's a series of steps along the way. But the key one today was anticipating this trend with these two moving averages coming together like that. I hope that answers that question.
Okay, again, thank you so much, Greg. There are a ton of questions coming in. I'm not exactly sure where we can go from here. You've got a couple minutes left. Maybe you want to give us your final thoughts. And I do want to mention, if you do have a question for Greg and we don't get to it, you can always email him. It's greg@fxdd.com. And then from there, you're always welcome to join our webinars as well if you want to listen and get a little more training. We also have another webinar coming up on FX Street in 2 weeks. I'm going to give Greg back the mic and he can finish us off. Thanks, Greg.
All right. Look at some of these questions here rather quickly here to see if I can determine. How do you determine where to draw your Fibonacci's on the 5-minute chart? Fibonacci's, I always look for the most recent obvious low. The market is simple. The market looks at a picture and you got to think like the rest of the market. So in this case, off the 5-minute chart, since the market is consolidating during this period, going up and down, up and down, up and down, all over the place, and we start to trend here, where did that trend start? That trend started at this point right here, started to move to the upside here. So that's where I would next draw my Fibonacci. It is sorry about that. It's just off of the most obvious level that is the most recent low. During non-trending markets, it's often good to just find the low and high and put it in there and find the 50% retracement level and use that. I hope that answered your question to satisfaction. But I try to use the if the market's trending, I'll use it's not just the days range. If the market was trending to the upside, I'll use a 3-day and go back 3 days. But you can often show that on the hourly chart as well. Like on the hourly chart, I would take this low. Well, this is the same day, but I would use the same Fibonacci. But in this case, off of this hourly chart, this is the most recent high. The market moved up, came down, a pretty significant amount came up, and then trend to the downside. So obviously, this is the Fibonacci off of this chart, and 38.2 comes in at that level. Once you enter, what is the entry and exit method on the 5-minute time frame? The entry and exit level is just 2 moving averages. You look for the 100 is your trigger. This is one of the entries. Entries is the 100-bar moving average. Now I'll look at double bottoms. I'll look at failed bottoms. I'll look at a trend lines. If it holds a trend line, I'll on an entry, I'll look for a Fibonacci retracement. This would be an entry level against the 100-bar moving average. Someone who a move below the 50%, up to the 50% retracement level here, or I don't know. There's different things, but from the perspective of this presentation here today, the blue line, the 100-bar moving average, is my entry on the trade. Now, where is the exit on the trade? And in this case, in the euro dollar case, my exit would sorry again, I have this cold, but my exit would be or I would get concerned against this 38.2% retracement right here, because why? We tested it and failed. We tested it and failed. And so if you are long from down here, you might look to take some profit at this point right here. And if you take some profit at this point right here, what you should also do is recognize is that if it goes through this level, what does it say? It says if we're going higher. So you might want to get back that part of that profit or that piece back in and get long the full amount again for the move to this level, or possibly even test the 200-hour moving average. These are all targets down the highway, down the bullish highway. Now, if the market goes above the 38.2% retracement, you go long here, and it goes up to, let's say, 60, doesn't get up to the 78 level and comes back down below the 48 level, get out of that position again and get rid of your other position if it goes below the 100-bar moving average. But the point is, it's all set up where you get in. And then you're managing a profit. If you're managing a profit, that's better than managing a loss, isn't it, folks? You manage a profit. You're not going to lose money on this trade if you're long in this area, or even at this point, this area right here. You're not going to lose because you're not going to let it go below the 100. If it goes below the 100-hour moving average, you're out, and you're going to have at least a profit in your account, folks. And that's how you increase your account value, by making profits and by doing trades that make sense. So blue has to be above the green to buy. No, blue does not have to be above necessarily above the green to buy. In this case, the blue is below the green line here. But when the two moving averages are together, that's a special situation where it says the market is non-trending. In this case, where the two moving averages are far apart, the blue, obviously we're trending to the downside, and you're looking for those points where the market turns its bias from bearish. In this case, if on the hourly chart, where are you going short? You're going short here. And you're short. And if you were just looking at this hourly chart, you'd be getting out here. But I'm smarter than that. I look at the hourly, I look at the 5-minute, and I would be getting out here, or I would have gotten out a while ago off the 5-minute chart during this consolidation phase. Why? Because the trend is over on this. and now are non-trending. But in this case, if you were just initiating a trade against this 100-hour moving average right here, you would be long at 127.17, and you could do that. I mean, you out there now could go out and buy against the 120.17 level, but the price is at 120.14. You're going to risk that amount, folks. But someone could have bought in at 120.20 or 22 and said, okay, my stop is at 120.05. I'm going to risk my 15 pips on that trade, and in anticipation that market's going to get through the 38, go to the 78, go to the 50, and perhaps even head up to this level. This is the progression. So from a trader's progression, this is another buying opportunity here above the blue line. But you know, it's not as good as being long down here, of course. But it is a trading opportunity, and it is at a level that the risk is limited compared to other trades. So do you understand that dynamic as well? It's all trading is about trading at levels where the risk is controlled, where you know where you know where you should get out. And if you can do that, if you can understand and know a reason to trade, and if that reason often is the reason to get out as well, you have risk all under control. And as long as you can accept that risk, then fear has disappeared as well, and you're able to win. Now, would I buy right here? The further you get away from your stop, the more fear you're going to have, and the more risk. You're just going to not trade as well. So you really location and understanding where the best levels are and trying to anticipate a move one way or the other really is the key. And this really is the best area today. This is the best trade of the day. It was all set up, and it doesn't take a brainiac to realize that the market's not going to stay in a 100 pip range for the week. Is it? I mean, is it really going to stay in a 100 pip range for the week? The chances are no. It's not going to stay in a 100 pip range. I don't think we've had a 100 pip range in the euro in a long time. And if it did, even the more power to us. Why? Because it's still it's non-trending. It's like a coil, a spring getting tighter and tighter. The longer a market non-trends, the better chance that you're going to have a trend. So you just continue to wait for it. But just intuitively, 1-2.5 days where the market is going sideways says to me, you know what? We're gonna break out here some way or another, and we're gonna go to the upside. So I'm out of time. I'm sorry I didn't get it to everyone's questions. Greg at FXDD.com is my email. And the other thing is, if you go to FXDD.com, you can see my my picture there, and my blog and commentary and all that other stuff, and learn more about what we do and how we do it. And I'm going to be doing more of these webinars for FX Street. And each of them are going to be an educational webinar that'll make you better, that'll make you be able to catch those trends. Thanks, everybody.